everyone, my name is Cherry Chen, a real estate accountant here in Canada. Today, we're going to talk about how to turn your primary residence mortgage that is normally a non-deductible mortgage into a tax-deductible mortgage, and so you can save more taxes. In Canada, we're technically not allowed to deduct the mortgage interest that you incur on your primary residence. To turn it into a tax-deductible mortgage, there are 5 steps that you need to follow. And today we're going to go through the 5 steps. First of all, you need to make sure that you have this reinvestable mortgage product attached to your primary residence mortgage. What is a reinvestable mortgage? A reinvestable mortgage is essentially a mortgage that would allow you to increase the line of credit that has 2 components. One is that it has a mortgage component and it has a line of credit component attached to your primary residence mortgage. And as you pay down the primary residence mortgage, the equivalent amounts, the same amount, would be available for you to use on your line of credit side. So if you pay down $1,000 of your mortgage, now your line of credit availability would be increased by the same amount. That is a reinvestable mortgage, and it is important to have this product implemented on your primary residence mortgage before we begin the whole process. That's step number 1. Now, step number 2 is that obviously you need to invest. In Canada, you are eligible to deduct interest expense that you incurred for the purpose of earning investment income. Second step is that when you collect your rental income, you can collect the rental income and deposit it directly into your primary residence mortgage to prepay your primary residence mortgage. As you pay down your primary residence mortgage, the equivalent amount is going to be available to you for you to draw out in your home equity line of credit, the HELOC. Now, if I use number as an example, if you collect $2,000 rent on a monthly basis from your rental property, on an annual basis, that means you get $24,000 rent. And you take that $24,000 before you pay any expenses, you dump it all into your primary residence mortgage. The same $24,000 is now available for you in the form of home equity line of credit, the HELOC. The $24,000 is now available for you. Now, of course, because you're operating a rental property, you have expenses that you have to pay, your rental property mortgage, rental property maintenance, rental property insurance, rental property tax. So all these things you have to pay. Where is the money coming from? You now take the 3rd step and you take the money from your HELOC, your primary residence home HELOC, and take the same $24,000 and put it in a dedicated property bank account. Now, it's important to put it in a dedicated bank account to make sure that you would be able to prove to CLA that the money is used for investment. So you put the $24,000 in my example into a dedicated bank account, and you use the funds to pay for all your expenses, the mortgage, the property tax, the insurance, the repairs and maintenance, property management fee, advertising fee. You use that fund to pay for the the expenses of the property. And that is how you would be able to get a bigger deduction. Now, people ask me how much money can you save if you have gross rental income of $24,000 annually. Well, if you take the calculator and do a quick calculation, $24,000 is the amount of rent that you use to pay down the primary residence mortgage. And you draw it out, and now you are incurring interest expense of about 3%. Interest expense of the HELOC that you draw out is about $720. That 3% is equivalent to $720 annually. Multiply by your marginal tax rate. Everyone's marginal tax rate is different, but if you are doing it, if you are in the 50% tax bracket, you could save $360 annually by just redirecting the fund. You don't have to recreate anything. You don't have to spend any additional money, because that $360 interest expense you would otherwise be paying it through your primary residence mortgage that would not be tax deductible. So these are the 5 steps to convert your primary residence mortgage into a tax deductible mortgage, and you can save more taxes. If you'd like to watch more Canadian real estate tax tips, please comment, like, and subscribe below.